Right, it's that time of year again where you're already forgetting about how bad this one was and you're getting your hopes up that everything's going to be much better in just a few weeks because the calendar now says 2023 rather than 2022. But until we get there and we see what's ahead of us, why don't we make our own predictions about how bad or how good things might get? So last week I ran 4 different community polls here on YouTube that you've all kindly responded to, asking you everything from what you think the S&P 500 might end up on next year and what house prices might look like too over the next 12 months. And I think the results are pretty interesting, so let's go through them each one by one, see what you thought. I'll then give you my thoughts too, as well as looking at some of the other experts and what they say alongside the data. Right, let's jump straight into the first hot potato of 2022 that's easily going to stay hot for 2023, and that's interest rates. Now, as you'll know, central banks like the Bank of England here in the UK and the Federal Reserve over in the US have the balancing act of trying to keep things stable in the economy, especially when it comes to managing inflation. Our Bank of England is slightly different to the Fed, as you can see here. When you look at actually what the bank has responsibility for, you've got secure banknotes, stable prices, safe and sound banks, and a resilient financial system. You'll see that there's no mention here of employment, which is one difference mentioned here when you actually look on the Fed's list of responsibilities, but generally they're trying to do the same thing. Now, as you may know, interest rates are one of the main tools that central banks have to keep inflation in check, which over the past year has been getting a little too crazy out there, causing double-digit increases in the things that we need to buy, especially things like fuel and food. So first things first, what do you guys think? Well, here are the results of the poll. The question was specifically about UK interest rates set by the Bank of England, which currently today sit at 3%, which is pretty high when we look back at least in the last decade. The majority of you, 53% of everyone who voted, reckons that interest rates will be between 3.5% and 4.5%, so around 30% higher than they are right now and up to another 150 basis points on top of 3%. Then interesting enough, that leaves us with around just under a third of you thinking that rates will either be where they are now or actually lower within a year. Then the final group, less than 20% of you in total, think rates will be moving higher, around 5% and as high as more than 6.5%. Ouch. I'll probably add my own guess here and sit with the majority of you, something like 3.5% or even 4%, and I think they'll be held there until inflation gets under control. And I think the difficulty is that inflation in the UK has been a much greater challenge than we've had in the US, for example, as we've seen double-digit increases with our last official number coming in at 11.1%. And if the data here from Trueflation is anything to go by, which is a platform that collects up-to-date information, then we're not going to see a slowdown for a while. So that's going to put a massive pressure on the Bank of England to keep things under control. So they'll almost be forced to raise rates, but then the issue is that the UK economy might not be able to stay stable. Basically, they're between a rock and a very hard place, and I reckon they can't really go much above 4% because that will play a part in making any possible recession a pretty bad one. If we look to see what the wider market thinks and what the data says, we know that public sector workers and other industries are currently striking right now to get better pay deals as they've seen their wages shrink over the years, as not getting pay increases that have kept up with inflation has caused them a lot of pain. And this is confirmed from brand new data that's just been released by the Office of National Statistics here. And as I showed in my property market video a few weeks back, real wages are not keeping up with inflation, so in real terms, people are getting paid less, and the latest data confirms this. Apparently, it's the second largest fall in real wages since the records began back in 2001. And as you can see on this chart, anytime the lines fall below the zero line, it shows us that we're losing the buying power of our money and effectively earning less than we did last year, even if we technically got a pay rise. Now, we could do a whole video on this topic, but overall it's going to be a tough year in the UK ahead as interest rates affect not only the mortgage market, but the bond market too. And let's not forget that this has a huge impact on UK government spending, as in they've got to borrow more money at higher interest rates, meaning that they'll end up spending more taxpayers' money on interest payments. Overall then, the only image that I've currently got in my head is the everything's fine meme where the character is sat in a burning house. And the burning house is the UK right now. And just before the UK economy does burn down, if you are enjoying the video, please hit the like button for me, hit subscribe too. It really does help out small channels like mine reach more people like you. And thank you very much for doing that. Right, second topic that you voted on. We'll keep this on the UK track for now and do UK house prices. As I've learned from a couple of my latest videos, probably one of the most emotionally charged topics that you can have with a Brit outside of politics, religion, or what you name you give to one of these things. I'd probably say a bacon roll, but I've lived in London, Essex, Newcastle, and now Manchester, so I switch between a roll, a bap, and a balm. Anyway, here's the result of the poll to the question about what do you think about house prices will do in the UK over the next 12 months. Now, as you can see, the majority of you are quite pessimistic and are going for either a correction of 5 to 8% or a whopping quarter of you are going for a worst worst case scenario of anything from 10%, 20%, or even worse. Then the final third reckons about the same or a small rise up, as they have done for the past few decades. A very interesting poll, this one, because there's so many moving parts in the market and it really also depends on where you live too. I'd definitely say a small correction, though in general, I think the biggest concern has to be the impact on first-time buyers with those interest rates. Gone are the days of just paying less than 2% on your mortgage, and buyers are now approaching 5 to 6% on their mortgages, which has a massive hit on what you can actually afford as your first house on the property ladder. I went into detail on some of these statistics on my property market video here on screen now, which you can check out after that if you haven't already, but let's at least look at some of the brand new data which came out from Rightmove, which I think is pretty interesting. So here's the latest report on screen now from December 2022, and I think there's some trends which are developing which would suggest a potential slowdown. First up, every single region is down month to month, so no matter where you are, you'll be seeing a slowdown, but there is big variation in each region. So if you look at London, for example, it's actually got the longest time period to sell a house at 57 days versus the West Midlands at 42 days. But check out the average London house price, it's 666k. The devil really is in the details. And when we put all those together, here's now what the longer term chart looks like. As you can see, the trend now looks to be heading down, and the monthly change in house asking prices has seen its largest fall for a while at more than 2%, which is a far cry from last year when every month the market was just on an unstoppable rise up. A couple more interesting points which I'll probably have to cover in more detail on another video, but they also look at how much stock the average agent has, and this is falling slightly, but it's not that volatile, which I thought was quite interesting, which just shows how the market has so many moving parts. For example, if the market looks like prices are falling, then lots of people who might not have to move and can just put up with their current house can just stay put. And also house builders who don't want to sell their stock off cheaply can just stop construction and wait around. And while there's going to be cost to that, they might not think it's going to be worse than selling cheap. Now all this means is that there'll be less supply entering the market, keeping that demand at a similar rate. Then on the demand side, if prices are too high, you might see first-time buyers wait around and save more money, or they might just choose a cheaper property, causing more competition in the lower end of the market compared to the higher one. So many things happening in the housing market, it's really hard to keep track of. Anyway, just before the next topic, let me show you this final part of their report when they look at affordability, because I think that's the key thing. Now, as you can see here, the green line shows mortgage payments with a 10% deposit and how they compare to rent payments over time. Mostly they're quite well aligned, so those people who rent could technically afford a mortgage. Obviously they still need to get a deposit, which isn't easy, but the last couple of months have really changed things with those interest rates spiking because of all of the political turmoil that we've just had recently. Now the big issue you have is that if first-time buyers can't get on the market, they make up almost 50% of the buyers, so that really causes pain from the demand side, which you would think would have to have some major effects on pricing, but hey, let's wait and see. And finally, just another interesting bit of data that I've not really seen before and paid attention to. This chart shows what one buyer versus two buyers might be able to afford with 4.5 times their average salary, which is about what the limit that the bank would give you a mortgage on. Interestingly enough, if you are buying as a couple, which I'll have to guess must be most people, then it looks like affordability is not too bad. It's the single people that suffer, where clearly buying a home is not really an option unless you've got some major cash to put down as a deposit. Whether these lines trend down over the next year, who knows, but I do think there's plenty of things to be pessimistic about in this market, and something has to give. I'll probably do a video in January at some point, so look out for that one. Okay, third prediction before we move on to the US stock market. Where will the FTSE 100 be in just 12 months' time? The good old UK index of our 100 biggest companies, which funny enough generate most of their income from outside the country. So it isn't really a reflection on the UK economy. It's more about whether you think old boring dividend stocks and global giants will do well through what will be probably some kind of recession. Here's what you thought on screen now, and I have to say, as miserable as we are sometimes as UK investors, there's probably a little bit of optimism baked into these votes, which most of you are saying that the index will either stay the same or have a slight bump. I do agree with the comment below from you, Chris, that inflation will work its way into earnings and there will be a partial way out of the recession, because we have to remember that the companies that make up the index are largely based in industries that are essential for business and consumers regardless of the global economy. You've got the big oil giants listed here, as well as the big financial players too, who are always going to make profits and have opportunity, and while some of it might be cyclical and it won't last forever, there's enough at the moment for dividend growth to see 2023 being another solid year. So for me, I'll go with a little bump as well. I think we'll probably see investors still be a little fearful of the growth stocks and hype stocks from the last couple of years, and stocks that pay dividends and generate real cash flow will be right at the top of people's minds as they look to grow their portfolio and keep their money safe. This seems to be what the market analysts are saying too. Now, I don't know the exact sources for these predictions, but I'll show you them anyway, and apparently December 2023, here it is. The forecast for the beginning of December, 7,412, a maximum value of 8,018, while the minimum minimum is 7,110. Average FTSE value for the month will be 7,526, and the value at the end will be 7,564, which is a change in December for 2.05%. So clearly some big differences there from analysts, some very bullish to call over 8,000, but hey, I guess that grabs the headlines and gets people's attention, I suppose. I'd be very careful what they're trying to sell. And just one final note on the FTSE 100, I'd be very interested to see how exchange rates move over the next year, as the pound to dollar rate plays a big role in the earnings in this index. As a lot of the money is generated outside the UK, once converted back into pounds, if we see our pound get stronger, as it seems to be finally moving, the profits earned will appear lower, whereas the opposite is true if we weaken like we have been. Just another thing to be aware of if all of this wasn't complicated enough. Okay, the big one you've all been waiting for, where will the S&P 500 close in the next 12 months? Here's what you all thought now from the poll on screen now. So definitely a positive slant, but not overexcited or expecting anything stupid, I'd say. You have about 3 out of 4 of you saying that the market will either stay around the same levels or be a bit higher than it is right now, with a good amount of you, more than 30%, seeing a rise in line with the average returns of the market over the very long term. So without asking you individually for your reasons, but feel free to comment those below, let's try and look behind the curtain and make a few assumptions. Funny enough as well, just as I'm making this video, the latest CPI report has literally just been published and it sent stocks to the moon for the day, at least so far by the time I'm saying these words. Inflation has come in below expectations and investors are seemingly assuming that the Fed in the US are probably only going to raise interest rates by 50 basis points and inflation's coming down faster than thought. So what do I reckon? Well, sorry to be boring, but I would also agree with you too. I do think that a lot of the fear has been baked in. We've seen some pretty big sell-offs across the market, especially in the tech sector, and lots of the high-tech hype stocks, as well as the SPACs. But it's not like earnings have fallen apart, at least just not yet. The big boys still make money, Apple still sells phones, at least the ones that they can produce and ship back home, and companies like Microsoft and Google still generate huge sums of money from businesses who can't survive without their services. So let's say a price target of 4,355, just to be precise, for no other reason than if I get close, I can be a genius, and if I miss by a mile, I can just say that it was only a guess, and the prediction shouldn't be made about the future. I should be an economic forecaster, it sounds like a wonderful job, you can just make stuff up. Right, again, we could talk for hours on this topic about the whys and the details about why the S&P 500 might move in all directions, but let's see what other forecasters think. Heading over to FactSet, who collect this data, here is what they reckon. Industry analysts in aggregate predict the S&P 500 will have a closing price of $4,493.50 in 12 months, and on December the 8th, the bottom-up target price for the S&P 500 was $4,493.50, which was 13.4% above the closing price of $3,963.51. Okay, so just like you lot, the analysts are also fairly optimistic too, but I'm sure the usual media sources will pick on the extreme bull and bear cases to create some scare stories from the start of the year. I do think that a lot of the short-term pain all lies in the interest rates, how long they stay high, how much we're able to bring down inflation, and how much pain they have to cause in order to do that by putting people out of work, causing the cost of government and personal borrowing to rise. Now, that's definitely a job I really wouldn't like. It doesn't seem like one you could win. If there is a US recession, I can see it being a weird one, nothing like the dot-com crash or the great financial crash, but more of a stagflation where not much growth happens, but it's not like things are in crisis mode. There will probably be plenty of people out there spending money, personal debt might keep rising too, but overall, the average person will get through it. Also, I'd say similar to the FTSE 100 comments I made earlier, expect those boring dividend stocks to keep doing well, as more investors who are newer to the market now want value stocks and are sick of seeing growth stocks in the red every single day in their portfolios. Anyway, please remember that making predictions about short-term movements in the stock market is a complete mug's game, and everything in this video is just for a bit of fun. Long-term investing is the way forward, and all of this short-term noise and shouldn't really affect regular dollar-cost average investing into mainly index funds over the decades. And we can thank our past selves next year when we review this video, unless it's so bad that we can make a comedy about it. Who knows? And on that note, drop me a like on the way out, subscribe for more, and as always, happy investing.